All right, welcome to Sacred Account Saturday. I'm Jerry Fetta, the owner, founder, and CEO of Wealth Dynamics. It's good to see everyone this afternoon. If you're tuning in for the first time and you've not been on, we've been doing these courses every weekend for probably the last 4 or 5 years in a row now. And so a big passion that I have is teaching people how money works, the truth about how money works. And a big part of that is my backstory is, I grew up in a household probably much like you, where we weren't rich, we weren't wealthy. There wasn't a knowledge of finances. And so I felt very unequipped, starting life out as an adult, never being trained, never being told like, this is money, here's what it does, here's how it works, here's how you use it. And that led me to making financial mistakes very early in life that actually limited my freedom. Right? So money is a tool. It's something that if we use it correctly, it can give us freedom. If we don't use it correctly or we use it unintentionally, it can really do a lot of harm and damage in our lives. Right? And that's really like one of my missions and passions. I want to help families, individuals, and entrepreneurs, number one, become financially educated. And that's why I share these courses every week. Okay. So my intention today is first things first, to teach you some of what I've learned, because if someone would have sat down and taught me some of the things that you're going to learn today, it would have made a difference for me, right? And now that I know this information, it is kind of, for me, an ethical responsibility to share this with as many people as possible, okay? The second thing is I want to help families, individuals, and entrepreneurs become financially solvent, right? Solvency means that I'm earning more than I spend, right? It means that I'm on a savings plan. It means that I have more in assets than I have in liabilities. I own more than I owe. It means I'm credit worthy. It means I'm properly protected against risk. And so I'm never going to go backwards. I can maintain and I'm never going to go backwards. That's what solvency means, right? And you would be surprised by that definition of solvency, how few people actually meet the basic definition of solvency, right? Like the solvency thing is such a foundational step. So one of my goals is, yeah, we want to build wealth. We want to build financial freedom for sure. But before we can get there, we need to be educated and we need to be solvent. We actually need to have a foundation. It's kind of like talking about, hey, I'm going to build a skyscraper and I'm talking about what the penthouse is going to look like, but I don't have a plan for the foundation that's going to hold it up. And solvency is that foundation. Okay, so that's something that I'm focused on. And one of my intentions is to help you, help families, help individuals, entrepreneurs in North America, the US, Canada, Puerto Rico, all the areas that we're expanding into right now, become more financially solvent. Okay, and then finally is achieving greater financial freedom in life. And this is your own definition of what that means. And that's why I say achieving greater financial freedom in life. It's not a destination. There is no absolute state of financial freedom. There's increasing degrees of financial freedom, and there's decreasing degrees of financial freedom. And so my intention is to help you increase financial freedom, right? And if you think about it, like let's say today that I teach you something that solves a problem for you in your life financially. You've just increased your financial freedom by the degree that information helps you. Right. On the flip side, let's say that, you have information in your world that caused you to get into, massive consumer debt. Right. To the degree that you're in debt, you have lost financial freedom. Right. You went backwards. And so I want to see people always increasing and going forwards with their financial freedom. And that's a big part of what we're going to talk about today. Right now, a few ground things I like to cover every week. The first one is, okay, we have to remove this idea that's been marketed into us by banks, by Wall Street, by large financial institutions, that money is complicated and it's something that we need the help of a professional with, and it's not for the layman to understand. And so because of that, we shouldn't even try. We just need to go hire someone that knows what they're doing. Right. And the fact of the reality is that's not true. Okay, money is easy. It's something that's easy to understand. Okay, it's simple, right? I've talked about this before, but money comes down to, really just, numbers and mathematics. And those numbers and mathematics are represented by words. Okay, one of the most helpful things that I learned, as I got my start in the financial industry at the age of 18 was the guy that was managing me. One of the things that he did right was he focused on making sure I understood that the only difference between me and him was the vocabularies that we had. Okay, he would literally say this. He's like, Jerry, the only difference between me and you professionally is that I have a bigger vocabulary than you. That's it. Okay, other than the vocabulary, there's not much difference. And so even today, And it may seem far-fetched, it may seem unrealistic, but the difference between me teaching the course and maybe somebody that's in the audience right now watching is just the vocabulary. I've just spent more time looking the words up, dealing with the language, understanding what things mean, gaining mass on, okay, here's the word. What does that actually look like in real life? And practicing it. Right. And so one of the things that I want to have you unlock is just, it's very hard to learn about something when we think we can't learn about it. Right. Like I would say, like, this applies to anything. If you go into it imagining you're going to fail, imagining it's not possible, you go into something like that endeavor is going to fail, not because it's impossible and you're going to fail, but because you decided ahead of time that's the case. Right. So much of our worlds and lives rest on our decisions. Right. And so if I'm deciding going into this today, then I'm saying, okay, I'm not going to learn about this. It's too complicated. It's something that, it's not for me, whatever, then yeah, I'm not going to learn about it. Right. But if I go into this with the mindset, this can be learned, right? This can be actually understood. It can be applied. Then that's the reason it will be. Okay. Rebecca, good to see you on here today. So check this out. Like I'm from, I'll tell you my backstory real quick, just to give you some understanding of like how possible this is. So guys, I grew up in Big Lake, Alaska. Okay, yes, I said Alaska. Like I'm in Florida right now. Alaska is way up there, like to the left side of Canada, right? It's America's Russia. I grew up in Big Lake, Alaska. In my city, the town I lived in, Big Lake, there's probably 3,000 to 5,000 people. My graduating class had 62 kids. And so I was not somebody that was poised to be like, yeah, I'm going to go start an international business endeavor, right? My parents, we grew up, like when I was 8 years old, we lost our house, we lost our car. My mom and dad got divorced, and we were homeless on both sides. Like living with my mom, we were homeless in a camper behind somebody's house with no electricity and running water. With my dad, we literally were tent camping for an entire summer, right? I thought we were just camping. I was like 8. I didn't know the difference. It turned out we were homeless. Okay. We grew up, me and my 2 brothers, in the actual federal poverty bracket. Right. Like I remember my dad telling my mom, they were fighting one time saying we're literally in poverty. By federal standards, we're in poverty. Right. They made less than 30 grand a year. I don't know how much exactly, but I knew it was less than 30 grand a year, raising 3 kids. Right. And so my experience was, like one of not understanding money, not having any example of success with money, and really money and finances being a pain point for me. I grew up like with that as the root of why my parents were no longer together. The reason why I didn't have things, the reason why when there was moldy food in the refrigerator, I was told, eat it anyways, penicillin is good for you, right? The reason why there were bugs crawling through my cereal and sour milk, and I had to eat and drink it anyways, because we got it for free at a food bank and we couldn't afford anything better. Right. So I didn't have any special understanding of money. To be totally honest, I was probably in a deficit. Right. Like I had to probably like make up for not having, and then also the bad experiences I had and the negative false information that I had. I was probably behind the ball. So there's no reason why by age 30, I was able to build a multi-million net worth and have passive income and a multi-million business and help thousands of clients across North America, through Canada, United States. We're now expanding into Puerto Rico. We've got some clients in Europe. To be able to help people like this, learn about finances. Right. And my point here is if I can do it, you certainly can. And for me, it took just the decision that I could. Right. So I want to remove the decision. Money's not complicated. Money's not hard. It's not reserved for just the experts. And then I also want to handle something else that's going to prevent us from learning today, which is I know it all. Right. Thinking I know it all, thinking that there's a mountain of information and I'm at the very peak crescent, I'm at the pinnacle and there's nothing left to learn. Right? There's nobody dumber than the person who knows it all. Right? Every moron, every idiot, every mistake I've ever made, times I've been morons and idiots, I thought I was right before the mistake happens. Right? You don't know what you don't know. It's the awareness that I can know more, the awareness that there is more information out there to be had. And here's the thing, guys, information is actually represented, the accuracy and truth of it is represented by the condition that we're in. Right. So if I'm in a bad financial condition, or not even bad, maybe just not optimal, I want to do better and I don't know how. Right. I want to be making more money and I'm not. I wish I had more money saved and I don't. My money's sitting in the bank, not growing, and I wish it was. I'm nearing retirement and I wish I had more set aside. Those are all non-optimal conditions, right? And I have to look at that and realize I created that with my finances, right? And it's based on the information that I either have or don't have. Okay, so the information we have is what we're operating with. It's creating the result we have. It's no different than opening up a calculator on your phone, typing in numbers and wondering why it keeps coming up with the equation and the answer that it's coming up with. Well, it's because of the numbers we typed in, right? So if I've only got certain numbers and I'm getting the wrong answer, it's not the calculator's fault. It's my fault. I'm putting in the wrong numbers. I need better data, right? And that means I need to get new data. And it also means I need to get rid of old data. Now, one thing I'll tell you is initially a lot of it's removing the old data. Things we thought we knew. Like, I want you to take right now, take a truth you have about finances, whether it's right or wrong. I don't want you to try and figure that out right now. Just take something you heard, right? Money doesn't grow on trees. Money is the root of all evil. Can't get to heaven if you're rich. We're not the Rockefellers. Like, I want you to think about these types of things. Now, I want you to ask yourself, where did you get that from? Was it mom? Was it dad? Was it a student? Was it a teacher? Was it a peer? Was it a coach? Like, who did you get that from? Right? Now, what I want you to do is look at, okay, this is where I got that from. Here's the person. Here's the source. What are their results in the area of finance? Okay. Again, not making them right or wrong. Just look at, were they wealthy? Were they struggling? Did they have excessive debt? Did they own a home? Did they rent? Like, what was the condition of their finances? Okay. For a split second, I want you to ask yourself, do I want that same condition? Okay, and you don't need to dwell on this, just do I want that same condition? Is that what I'm trying to build? If it's not, that information won't help me get where I'm trying to build. It will get me with what they have. Okay, the second part of this exercise is now I want you to ask yourself, where did they get it from? They're not God, right? They're not the source of all financial knowledge. They got it from somewhere. Where was that somewhere? See, with most of the information I was taught about money, I couldn't get past that second answer. I don't know where my mom got the stuff she told me. I don't know where my dad got the stuff she told me. I don't know where, my teachers got the stuff they told me. Right? If you want to take it a layer even further, let's say you do know, well, where did they knew it, they said it to you, they got it from somewhere. Let's say you know where that somewhere was. Let's say it was their grandpa. Well, where did their grandpa get it from? We can't trace this back to a source to be like, that's a successful source. We should operate with this information. And so part of what I want to implore you to do today is to change where you get your financial information from. This is one of the most basic things you can do to succeed with money, is change where you get your information from. Don't even look at like who's around me and what have I heard and what have I done. Look at, what do I want to be like? Okay, financially speaking, right? I don't think you should model your entire life after anyone, but on the subject of finances, it's a very black and white topic, right? You either have or have not, or you're somewhere in the middle. And if I'm somewhere in the middle and I want to get up to the point where I've got more, then I'm going to look at the people that do have more and I'm just going to copy them. I'm going to say, what are they doing? That's where I'm going to get my information from. I'm not going to judge them based on their character, right? I'm not going to judge them based on the condition of their marriage or anything other than they get dollars or they get currency. What do they do with the currency when they get it to create? Because here's the thing is money, it just multiplies more of who you are already. So if someone's a shitty person, money will just make them shittier. See, the myth is another one, money changes people, right? Good. Okay, well, where did we get this one from? Okay, on this one, I don't even remember where I first heard this from. It's one of those generalizations. It's actually kind of suppressive. Money changes people. That's a very general statement. So you've got an entire society working, going to school, getting a job, getting good grades so that they can get an income, which is money. The very thing that we're all working towards as we're growing up. We don't really even know that that's the point of the game until like you're like halfway through high school and your parents are like, by the way, you need to start thinking about college and a job. Right? I remember that conversation with my mom and I'm like, wait, what? I thought life was about having fun and enjoying myself and hanging out with friends. And she's like, yeah, until you turn 18, because that's when you need to move out. And you're going to need to have a career and a job and you're going to pay your own bills. Now, all of a sudden, oh man, I need to get money. Okay, but money, it changes people and it's the root of all evil and I can't get to heaven if I have it. Do you see the problem that creates? Right? So changing this, money doesn't change people. Money amplifies more of what somebody already is. Okay, if I give a bad person money, they're going to use it to do bad things. If I give a good person money, they're going to use it to do good things. Now, here's where my purpose comes in. I don't want to help just everyone. I want to help the good people. right? I want to help the people that want to do great things, that want to live a better life, lead better, with a better example, support their families, build their communities, donate to their churches, invest in businesses, and make the area around them flourish and prosper because of what they do with their money. I don't want to invest in and help someone that's going to be a miser. I don't want to help someone that's going to support things that harm humanity. Right? I don't want to help someone that they're just going to go retire and visit beaches for the rest of their life. Like, great, that's not hurting anyone, but it's also not helping anyone. I want to help those that want to make an impact. And I cannot make an impact myself if I believe that money is going to make me a bad person and it's going to somehow change me. Right? It's kind of like saying spoons make you fat. No, overconsumption of calories makes you fat. The spoon is just the tool that you use to do the job with. Or guns people, no, kill people. No, bad guys with their finger behind the trigger that want to kill people, whether it's with a gun or a spork, they're going to figure out a way to do it. Right? Like, we have to look at the being. Am I a good being? And if you're a good being, and I think most people are, I want to help you. Right? I want to help you get the right education. Okay. So those are my house rules. Also, keep this open for questions, guys. So I don't want this to be a thing where you're the student, I'm the teacher, I lecture, you listen, and then you're just, oh, okay. This is conversational. I have knowledge I want to give to you. I want to help you. I want to answer your questions. I want to know what you're working on, what your goals are, what barriers you're facing. So drop your questions in the chat. I actually like to mic up with people. I like to go on live with you, turn on the microphones, talk to you, hear what you've got to say, and give you some one-on-one coaching throughout this as we're going through it. So usually in that scenario, one person's got to be the brave one first that's willing to get on the microphone with me and talk. And if that's you, I would love to answer your questions. Usually from there, people follow on and we have great conversation. Okay, so I want this to be a two-way thing, not just me verbally vomiting on you and hoping that, you know, you retain some of what I said. Okay, and then finally is, by now you probably have gotten a message from Bree. Bree and Jules also on my team. They're endorsed wealth mentors on my team. Okay, so as I've been building my business, we've been expanding. We've got over 2,300 clients across the United States, Canada, Puerto Rico, some in Europe. We've even got a guy in someone in Japan yesterday actually bought one of my books. That's the first time we've got someone in Japan now. And so I'm not able to interact with people the same way I used to on a one-on-one basis, right? As the CEO, I'm very focused on, you know, the quality of my company, the expansion, making sure we have good staff, right? It's kind of like we watched this movie. I watched this movie the other week called The Founder. Right? The Founder is the McDonald's story. And so they were really big on quality. Like, ironically, it's McDonald's, right? But back in the day, they were focused on quality. They wanted everything great. They wanted their kitchen to be flowing, ship shape. And so the owners, they would actually supervise the kitchen. They would make sure that the systems were in place and everyone was doing their thing. They weren't the one there flipping the burger, right? And so as my organization has grown, as we've expanded, there's two things I realized. Okay, if I want to talk to people, then I need to do it on forums like this where I can address you as a group. We can go live, we can talk, kind of like the old school, you know, AM talk radio where you can call in. That's the best way for me to be able to talk to as many of you as I can, because I love talking to people. The second part is, in order for me to be able to reach as many people as possible and help them, I need a team of people that I've trained and given my personal stamp of approval to. Okay, and so that's what Brianna and Jules are. They're endorsed wealth mentors. An endorsed wealth mentor is somebody that I've personally trained. They have my endorsement. And so meeting with them is the equivalent of meeting with me, because they're going to teach you all the same things that I would. That's their purpose, right? And so they're kind of the one-on-one face of the relationship that you would have with my company, with myself, is having an endorsed wealth mentor. So both of them, by the way, I want to just acknowledge these two. Brianna and Julia, both of them just got promoted last week. So they earned their first set of promotions. And so that's a big deal. Like, they're very hardworking. They're both, you know, great examples of an endorsed wealth mentor. So if you know them, if you see them in the chat, be sure to congratulate them both on their promotions. That's very well done. And then also, you know, as they're reaching out, one of the things that they're going to want to do is set up a free appointment with you. Okay, their goal is to help, right? Their goal is to help, to answer questions, to give you guidance, to give you a personal relationship with someone in our company that you can work with. And they're going to coach you through what we call the blueprint to financial freedom, right? So they're going to be reaching out to you in the chat. They probably already have been, just saying, hey, I'm Bree, I'm Jules. You know, what made you tune in today? How can I help you? Let's set up a call. And this is whether you're an existing client or not. If you're an existing client, Nick, Rebecca, Reggie, Travis, Andrew, all you guys that are in here, My ideal scene is every single client has a dedicated one-on-one in relationship with an endorsed wealth mentor. Okay, and so that's a super high priority. Set up a call with them. Let them know, hey, I'm a current client. I have these services, and here's kind of how this works. Is if you're a current client, okay, we just really started getting this organized this week. You guys are gonna love this. Just a quick update on things, right? So we have the client. Right, the client is working with the endorsed wealth mentor, the EWM. Right now, the EWM's job is to find out, like, what are your needs, what are your wants, provide the education, the service, answer the question. But their main thing is to help you move on your blueprint to financial freedom. Right, wealth has an organized sequence. It's a blueprint. There's a reason why wealthy families continually build generational wealth, because they're not guessing every new generation on how to do it. They've got a playbook. They wrote up what they did. They said, here's what you do first. Here's where you do that. Here's the people to go do it with. Don't do that. Don't do that. They give a lot of details. Good. That's the first step. Here's the second one. And it's a step-by-step sequence. Okay, so I've been in this industry since I was 18. I'm now about to turn 31. That's going on 12, 13 years now. And I can't tell you how much guessing I had to do. So I spent the last decade plus of my life studying old, dead, successful, wealthy families. What did they actually do? Right, the Teddy Roosevelts, the Andrew Carnegies, the John Rockefellers, right, the JP Morgans. What did they actually do? Because within that, there's a whole sea of data. There's some similarities and some commonalities and some sequences. And I started studying that, and I learned, here's actually what they do. And I started doing that, and it actually works. Right, and those of you that have been clients of mine, you've seen it working. You've seen it working with me. You've seen it working in your own life. Right, it's cause and effect. You do this, that will happen as a result. And so the EWM, their job is to educate our clients, provide service, and help them move through the steps of their blueprint to financial freedom, following that successful sequence. Right now, part of that is with our endorsed wealth mentors. If there's ever a question as to, like, what's the right strategy, or you have a unique situation that's come up, or you need help one-on-one, they're going to do something called a blueprint consultation. We call it a B2F. Blueprint to Financial Freedom, B2, that's why there's two Fs, a B2F consultation. Okay, a B2F consultation is with Samantha Esteleo. She's my Chief of Performance and Delivery, and she's going to sit down and do a one-on-one interview with you and ask every question under the sun about your finances. What have you been doing? What are your barriers? What are your goals? What do you need help with right now? Everything she needs to know, and then she's going to find out what you've done with us so far and kind of get that fully figured out. Then what happens is she's coming up with something called a technical estimate, a TE. Okay, a technical estimate. Here's the strategy. Based on where you're at, based on the goals you have, based on what you've done so far, here's the exact step-by-step sequence in writing on paper of everything you need to do from this point to get your next things completely taken care of. Right? That TE goes back to your endorsed wealth mentor. And they're going to say, good, we've got the game plan from Samantha. We've got, and Jerry's helping with this as well. I'm helping her build these TEs. Here's the first step. Let's get it knocked out. And then they coach you through the entire thing. Right. This is very different than the normal financial industry. So that's the experience that we're creating. If you're an existing client, I want everyone on this call today that's an existing client to get connected with an endorsed wealth mentor and schedule a blueprint consultation. Okay, you can know that the technical estimate me and Samantha are building. I trained her myself. I'm working with her on all of these right now. And then that our endorsed wealth mentors, they're going to do exactly what we've told you guys to do on the TE. Here's the exact steps. There's no variance. There's no mystery. There's no maybe. There's no do I have the right thing. This is what came from Jerry and Sam. Right? We're going to now get the first step done. Let's get started. Okay, so that's really what we're doing and what we're creating. So I want to make sure you guys know that. So if you're reaching out, you're hearing from Jules, you're hearing from Bree in the comments, that's what they're going to be focusing on if they do a one-on-one with you. And then the second thing is, if you're not a client yet, I want to make sure you get a copy of my book, Blueprint to Financial Freedom. Okay, I wrote this book, and this is the one I just described, but this gives you the sequence to building wealth. Right, so if you go to jerryfetta.com/B2F promo, you can get a free copy of the book. You cover your shipping, we'll send the book out to you. Right, if you buy the book, you also do get to meet one-on-one with an endorsed wealth mentor to go over what you're learning. right? But this is, and the great thing about this, guys, I'm 30 years old. This is not my information. Like you're not like, okay, I'm going to base my entire life off of what a 30-year-old from Alaska says. This is the last 10, 12 years of research and application. What did the Rockefellers do? Okay, what did Carnegie do? What did JP Morgan do? Andrew Carnegie, wealthiest man in the United States, died penniless because he donated 100% of his wealth. Other than a tiny little bit, which he gave to his daughter. The rest of it went to charities, churches, social betterment. Like that's an ideal scene, if you ask me. How did that guy do it? Right. So this is the playbook. Like I did the research, I wrote up what it all is, how you do it, what sequences they are. And this works as well as it provides evidence of success. As long as you're doing it and seeing a result, apparently that's the degree it works. Okay. So if you're not yet a client, I want to encourage you. Today, go to jerryfetta.com/B2F promo and grab a copy of the book. Okay. And again, free book, you cover the shipping, we'll send it out to you. Okay. Now, what I want to really go over today, I know I've covered a lot of different things so far, but the main thing I wanted to go over today is called the Sacred Account. This is called Sacred Account Saturday. Okay. Sacred Account Saturday. Now, I want to start this by saying right now, if you look around us in the world, like what's going on financially is we're having large banks and small banks even starting to fail, right? If you look at Silicon Valley Bank, for example, right? They're going through what's called a bank run. They're getting, they're right now going through Congress for a government bailout potential. And what ended up happening, and I'll go ahead and sketch this for you guys. What ended up happening with Silicon Valley Bank? So we have the bank here. Put the little bank pillars, right? So we have Silicon Valley Bank and we have depositors. Okay, depositors are people who put money in a bank, right? So you and I, if we've put money in a bank, we're considered a depositor. We've deposited money into a bank. So when someone deposits money into a bank, right, they've got their dollars going in. What happens is a process called fractional reserve banking. Okay, this has been going on for decades and decades and decades, right? So the depositor puts the money into the bank takes that money and they do what's called fractional reserve banking. Fractional reserve banking means that they do not keep your deposits in the vault. Instead, they take your money and they invest it. They do that through loaning it out to others. They can invest in the stock market. They can do foreign currency trading. Fractional reserve banking, fractional means a portion. Reserve means the money that you keep, right? And banking is the process of accepting deposits and issuing loans and kind of everything that goes with that. So when you deposit your money, they keep a fraction of it in reserves for banking. That's what it means. Your money is not there, right? My favorite way to describe this, who's ever been to an airport where you drop your car off with them and store it for whatever, 2 weeks if you're going to Hawaii and you're like, I don't want to deal with my car, I'm going to leave it there. Okay, I'm going to pay them money, I'm going to leave it there, they'll keep it. When I come back home, I just go to the place, I get my keys. Who's ever done that? I've done that before, okay? So similarly, you do this with money. You get paid instead of, okay, I'm going to keep it all under my mattress and use it. Okay, I don't want to do that. I'm going to put it in a bank. They're going to keep it safe so it's there when I need it, right? Similar concept. Fractional reserve banking means you dropped your car off at the storage place. While you were gone, they rented it out on Turo and didn't tell you, right? They put it at risk. They let someone else drive and use your car. Okay, did you really miss it? No, you weren't using it anyways, but they weren't upfront with you about this, right? It's a different agreement. Like if I'm saying, hey, I'm going to rent my car out on Turo while I'm on vacation, that's different than I'm putting it in a storage place for safekeeping. I would want to know about it. And I would be the one like putting my asset, my car at that point at risk. So I want a piece of the profit if they're doing that. Otherwise, I would just go on Turo myself, right? I can download the app and I can put my car on Turo and make all of the money. Okay, so fractional reserve banking means just like with the storage, I deposit my money into a bank. The purpose of depositing money in a bank is to store it there. While I'm storing it there and I'm out living my life, they're not keeping it in the vault. They take this out and they issue loans to other people. They do investments and they do speculation even. They speculate with our money. right? This is all fine and dandy because guess what? They're paying me right now maybe like 0.30%. So they don't have a high risk, like they can cover my cost on my deposit, right? They can pay me my interest. And then think about this. If they're paying me 0.30% and they loan that money out to someone on a car loan for, let's say, 7%, 7%, how many times does 0.30 go into 7? That's a lot of times. So their cost, their difference between what their cost is and what they're making is astronomical. We're talking triple digits and higher, right? We can just quickly do the math on this. Like if we take 7 and we divide it by 0.03, that's 233. Okay, that's 233%. They're making a 233% return on my money. Okay, that's a lot. That's a lot, right? So that actually might be 2000. Correct me on my math, someone. Do I need to move the decimal here? Is that 23,333%? That's 233%. I think it's 233%, but that's triple digits either way, right? And they're not even putting anything at risk. It's my money that they're using. Okay, if they go invest and they invest in foreign currency, they could be making 50 to 100% returns. Okay, if you didn't know, foreign currency trading is one of the #1 profit centers for banks. Okay, Q4 of 2020, JP Morgan Chase Bank, they released their investment returns. They had their most profitable quarter ever, and their #1 source of profit was foreign currency trading. Foreign currency trading, meaning they're trading dollars against yen, they're trading, Canadian dollar against euro, they're trading British pounds against, whatever currency to take advantage of the fluctuations. I buy in this one and trade for that one. I've now got a difference in price and I can keep that difference as a profit. Very speculative, right? They can make 50 to 100% doing that. So if I'm paying them, they're paying me 0.30% and they're making 50%, what's the math on that? Right? Or let's say they just do a mortgage, right? They do a mortgage and they're making, 4%. Or a credit card where they're making, 19%. Bottom line is they're putting an asset at risk that's not theirs. Their cost of interest is very minimal. And then they're out there getting rich and speculating. Okay, now there's two things here. The first one is, why would I put it here? In this case, it's a Silicon Valley Bank, right? SVB. I don't know why I put a P there. Maybe P is for poor returns. But there's a Silicon Valley Bank. Why would I deposit money into Silicon Valley Bank if they're just going to go out and invest? Why not bypass them entirely and do the investing myself? The main reason is financial literacy. It's the thing I started with today. The only reason I wouldn't do this myself is I don't know how to. Okay, we're not taught this in schools. Even if you go to college, they're not teaching you this. You have to actually go learn from people who have done it. Okay, how do I loan money out on real estate? How do I manage and buy rental properties? How do I invest in a business? These are all things the bank is actually doing with my money. So if I just cut them out and do those things myself, I go directly to the center of profit. I make the 7%, I make the 50, I make the 4, I make the 19, rather than making 0.30. Okay, so that's the first thing. The second thing I want to point out is that's all fine and dandy that they can cover my interest, but what happens if I ask for my money back? Let's say that I went to the bank today and I pulled out all of it, right? So at a certain limit, they have what's called vault cash that's in the bank. They might be able to cover you, or they might have to wire money in from the Federal Reserve. Okay, the Federal Reserve is a private corporation that issues currency for the United States Treasury and also controls and monitors interest rates and currencies with their member banks. So if they don't have the money in that branch, Wells Fargo might say, hey, we need to request money from the Fed, pull it from our account with them, right? Because again, they don't have my money. Okay, the other problem is with that's one person. So what happened with Silicon Valley? Silicon Valley Bank did just this. People deposited money with them. They went out, they did a bunch of loans and stuff. They're going through some financial struggles. From what I read, their CEO started selling some stock as well, which created a bit of an emergency, right? Investors no longer wanted to invest in the bank. Here's the other thing is they have investors. You're a depositor, they actually have investors and shareholders. Okay, banks are funded by investors. That's their startup capital so that they can market, advertise, and get your deposits. Take those deposits, invest them, and pocket the difference between what they're earning and what they're paying you. So their investors started to get shaky and started selling, which caused the depositors to say, okay, we don't want to put money in here, right? So depositors started trying to pull money out, and guess what? They didn't have it. Why? Fractional reserve banking. Do you know the reserve requirement right now that banks have to keep in their vaults based on what's been deposited? In March of 2020, the same day the stock market crashed, the same time period the pandemic is released, the Federal Reserve Bank issues an order saying that their member banks have a 0% reserve requirement. It used to be 10%. They had to keep 10% reserves on hand. Now it's 0. They don't have to keep any of your money. They can loan all of it out. 100% of your money gets to go out into the economy. So it's not there. The car is on Turo. You're going to ask for it back, and it's still on Turo right now. That's what happened with SVB. So there's a couple things to look at. There's risk. Why would I put risk? Why would I put my money into an institution that's risking my capital? Okay, someone might say, oh, it's because, there's FDIC insurance. Guys, the FDIC is bankrupt. They're broke. They've only got enough money to cover 2% of the reserves that's required. Like if everyone pulled their money out of all the banks in the United States, right now the financial system would collapse, and the FDIC insurance would only cover about 2% of the deposits, and it would only cover the deposits that are over $250,000. Now, a bank like SVB, a very high net worth bank, most of their deposits were over $250,000. So there's individuals that they had 600 grand in the bank. Too bad, only 250 was insured. Right? Like you just lose out on that. So there's risk there. Why would I put my car somewhere that's going to rent it out and not pay me? Why would I put my money in a bank that's going to risk it out and not pay me? And sure, they're paying something, but not anywhere near what they're getting. You see that? So that's something we've got to look at. Another thing is, as I brought up, why would I not just bypass them and go do this myself? I can loan money out. Like I know how to do that. I can invest in real estate. I know how to do that. And again, I know how to do that. I don't want you to individuate yourself for me and say, oh, that's because you're Jerry Fetta and you've spent time doing this. Guys, the book's right there. I'm teaching you how to do it. If you really want to know how to do it, come work with us and we'll teach you. Right? Get the education so that you've got the knowledge so you can do all the stuff the bank does. Okay. Third thing is when they get the profit. Okay. When they get the profit, they don't even deposit it into their own system. Okay, they get their money, like they did the loans, they paid you your deposits, they've got profit. They did not deposit it into their own system. What they did instead is they put this, I'm going to just make some space here. So banks have something called Tier 1 capital. Okay, capital means dollars, right? Tier 1 means it's like the top tier, their most prized reserves, the money that they never want to lose. They want to make sure no matter what, they keep that money there. Do you know where the banks put the majority of their Tier 1 capital? Meaning they take your deposit, they loan it out to someone, they collect the interest, they pay you your interest, they keep the difference as profit. They immediately fund what we would call the emergency fund, their reserves, the thing that's going to keep them in business. Do you know where they put it? They do not put it in their own product. They put it in something called bank-owned life insurance, BOLI. You can Google this right now. Here are the statistics. There are over $200 billion collectively from over 3,000 banks in the United States putting their money in this life insurance. That's what they're actually doing. They're putting the money in the life insurance. Bank-owned life insurance, over $200 billion, over 3,000 banks in the United States. Bank of America, for example, I have a copy of their balance sheet. If you want to see it, reach out and ask. We can email you. It's over $22 billion in cash value. Cash value is the savings money that they have in the life insurance policy. $22 billion. The banks in America, these banks are the #1 owners and the #1 purchasers of whole life insurance, bank-owned life insurance. Think about that, guys. This is what I'm saying is we have to get rid of what we thought we knew. Okay, what did mom and dad tell us? Mom and dad told us, okay, go open up your bank account, save money for a rainy day. Okay, they didn't say that the money is being used to build wealth for a gigantic institution and that the profits of that are going into a life insurance policy. They're not even using their own product. And that I could be doing both of these. Guys, here's the thing is I can be doing this. So when I invest, my #1 favorite way to invest is called seller finance real estate. Seller finance real estate is where I buy a property, a family moves in, and then they pay me a mortgage. I'm not a lien lord. I'm not a property manager. I'm a mortgage. I'm now the bank. They pay me interest every single month for the next 20 years, just like a bank, right? I can do that. We have a company that's all they do. It's called Equity and Help, right? Not only that, they do it in a way that's not suppressive. Banks are doing it in a way that suppresses people. We're actually helping people with this, right? So I can be the bank, literally do the same loan schemes that they're doing in a way that's actually helpful for humanity. And I can be making 8 to 12% on my money rather than putting it in the bank where they're going to loan it out and do that anyways. Just bypass them. Let me go direct to the deal. Okay, the bank owned life insurance. We have something called the sacred account. Okay, we have something called the sacred account. The sacred account is a form of high early cash value dividend paying whole life insurance. It's literally designed the same way the banks use it. It's just designed for consumers instead of corporations, individuals, families, entrepreneurs, rather than gigantic banks. Okay, this is where I put my company reserves. I do exactly what the banks do. We bring money in off the top. I put money in my sacred accounts. I keep 1 month of cash in the bank for liquidity purposes, and that's it. Right? I don't keep more than that. If they go under, I'm going to lose a month. I understand that. Okay, most of mine's in my life insurance. Right? So you can be doing the same stuff here. Now, the question comes up, and this is naturally the question that comes up. Why aren't more people doing this? Why haven't I heard of this before, Jerry? Why is this the first time this is being mentioned? Right? And so this is one of the things that I like to point out. There's really two answers to this question. The first one is, it's not about how many, it's about who. It's not about who, like how many people are doing this, which ones are doing it. Right? Here's a great example, right? I can show you a majority of the United States overconsumes on calories and doesn't go to the gym. Okay, they're killing themselves. Right? Obesity is a gateway for most illnesses that you're going to experience in your life. Being out of physical condition, it's no different than treating your vehicle bad and then wondering why it breaks down. But I can show you that the majority of Americans don't go to the gym, they don't exercise, they overconsume on calories, and they eat garbage. Okay, that's the masses. That's what most people are doing. We could ask the question of, well, why don't more people go to the gym if it's such a good idea? Why don't more people eat less calories than they burn if it's such a good idea? Why don't more people take, proper nutrition and supplementation seriously if it's such a good idea? Okay, we can, as I'm saying that, I actually feel like an idiot while I'm asking those questions, even though it's fake, because we all know it's a good idea. There's no well, maybe you shouldn't go to the gym. Maybe exercise is bad. We all know it's not. Right? Maybe you shouldn't make sure you eat right. We all know that it's a good thing to eat right. It's irrefutable. Okay, so just because the masses are doing something doesn't mean it's a good idea. In fact, when I was, when was this, 18 or 19, 18 years old, okay, I learned that when the majority of people are doing something, I shouldn't be. If the majority of people are doing something, if I did the exact opposite, I would be successful. That was actually something I realized when I was 18, 19 years old. And even today, that's a stable datum of mine. If the majority of people are doing it, all I've got to do is not. I can literally just pick the opposite of what the masses are doing, and I'm going to do pretty well in life just operating on that basis. Okay, so that's the first thing, right? If the majority of people are doing it, it's probably not a good idea. The majority of people put money in a bank. The majority of people give money to Wall Street. The majority of people overpay taxes to the IRS. Those aren't good things. Those three organizations, if you could cut out those three organizations from your life, okay, banks, Wall Street, and IRS, you would flourish and prosper like you couldn't believe, because you wouldn't have a leech sucking the blood out of you as you try and grow financially. Right? That's all they're there to do. A bank, collect as much deposits as they can from you, to loan it out or invest it for the highest return possible, and pay you little to nothing and hope that you don't ask for the money back when they don't have it. That's the game plan of a bank. I just described to you their business model. I want to take a deposit from Jonathan. If I'm the bank, I want to take Jonathan's money, loan it out to Lawrence at the highest rate possible, pay Jonathan as little as possible, and hope Jonathan doesn't ask for his money and hope that I don't lose it. And if I do, we have FDIC insurance, which is underfunded and also taxpayer funded. You're funding your own bailout. They're pulling the money out of your own pocket to pay for their bad investing or for the risks that they put your money in the first place. I'm sorry, but that's a broken system. Wall Street, how do we come up with a financial product where we can promise nothing, collect as much in fees as we possibly can without going to prison? That's the valuable final product of Wall Street. Is it not? When you sit down with a financial advisor, what's the one rule? They cannot guarantee performance. Okay, they have to disclose fees, and they have to follow the law so they don't go to prison. Those are the three indicators of like their business model. Okay, we need to make sure that we don't guarantee what's going to happen because we can't, and then we collect as much money as we can without going to jail. That's their MO. Why would I give that organization money? Their focus is not prosperity generated for American consumers, right? Go on Netflix and watch any documentary you want about Wall Street. None of them are good, other than the one that Will Smith did, which was a cute little story about how this guy became a financial advisor, right? But if you look at the firm level, okay, there's a movie, what is it? It's escaping me. Okay, we're going to start doing some of these documentaries. There's a movie that I watched in 2020, and it was going over the 2008 crisis, 2008 mortgage crisis. Right. And so they had a bunch of great stuff in there. It was actually a documentary. They interviewed real Wall Street executives, lobbyists. They interviewed one of the most famous. It wasn't The Big Short. That's another good one. The Big Short wasn't a documentary. This was Smartest Man in the Room or something like that. But it's going over the 2008 crisis. They interviewed one of the top prostitutes in New York City. Right. And she said, they blurred her face out, right, obviously, and did a little voice garbling thing. She said that her top clients were the highest paid executives for Wall Street. That they would do drugs and cocaine and they would use her services. And that's who we're giving our money to. Right? Wolf of Wall Street actually happened. The Big Short actually happened. Right? You go back to 2020. Who remembers like in 2020, the pandemic's happening, and then it seemed like every Fortune 500 CEO on the planet was selling their stock and resigning? Who remembers that? Right? Like that's actually stuff that happens. Okay, so investing our money with people like with Wall Street's not a good idea. The same thing with taxation. Take as much as we can from the American citizen without giving an exchange. To this day, I'm still waiting to see what I got from my taxes that I pay. Right? Like those aren't places we should save. So those are the main three places the average person puts money. And we hear, oh, Jerry, why don't more people do this? Why don't more people know about it? If they did, it would probably be a bad idea. Right? So the thing is not just how many, right? So masses don't mean anything. It's who, which ones, like I said earlier. Okay, do I want to take advice from my brother-in-law at the Thanksgiving Day table, or my coworker at the water cooler, or the guy who runs the most successful bank on the planet? Okay, again, it doesn't mean we need to model them. Let's take Donald Trump, for example. Okay, I don't care whether you're a Trump guy or not. I don't support the guy or not support the guy. Honestly, I don't even get into the political thing. That's not my arena. But here's the thing is, do I need to agree with this guy's personal philosophies? No. Do I need to agree with his marital philosophies? No. Do I need to agree with his political philosophies? No. But he's a billionaire. There's something for me to learn there. The inability to learn from someone just because we don't like them actually hinders growth. A real growth-minded person can see past all the things we don't like and look at, okay, what, like that person is creating an effect in their life. What did they do? It doesn't mean I accept everything else about them, right? Trump is a perfect example. If you think the guy's an asshole, great. If you don't, great. If you think he's going to go to jail, great. That doesn't matter. He's a billionaire. He's built successful businesses. He's built a successful real estate portfolio. He pays very little in taxes legally, by the way, using the same tax code Congress uses. They wrote it. How do I do what he's doing in that specific area and look past all the stuff that I might not like or agree with? John Rockefeller, for example, one of the greatest wealth building examples that you could ever look at is a suppressive individual. Okay, I would not model any aspect of that man's life other than he built really good businesses and built, like, even to this day, more wealth than anyone in American history. And regardless of whether I like him, I can look at, okay, even if he didn't intend it, what he did has had a positive impact on people to some degree, right? You don't get money like this from stealing. You do have to be in exchange with people. I saw an interview of Howard Schultz, the Starbucks CEO. He's in Congress, and they're grilling him, right? And they're, Bernie Sanders is up there, and they're talking about the evil billionaires, and he stops them and he says, guys, I grew up in the projects. I built this from the ground up. Okay, I achieved the American dream. Quit hating me over it. And I loved that because it's the first time I've seen a billionaire stand up for themselves. Yeah, if you built it from the ground up, like we should be learning from you, not criticizing you. right? We have to get rid of this. We have to get rid of this. So I want to go over a couple of questions. And I do still want to cover my topic, which was how do life insurance agents get paid, right? So really quickly, I want to answer some questions. And then we'll jump into how life insurance agents get paid. And I do want to be totally upfront with you. The reason I'm showing you how life insurance agents get paid is I need good people on my team that want to become endorsed wealth mentors, right? If you're an active and winning client and you love what we do and you want to help my clients, my public, my followers, and also your sphere, your friends, your family, your community, implement and win with finances the way that you have, okay, the route to doing that is to become an endorsed wealth mentor. So I just want to kind of show you, like, as a consumer, as a client, the way that a life insurance agent gets paid actually has a very high impact on the performance of my policy itself. So I want to know that. And the second thing is just from a business model, like if you're on this call today and you're like, hey, I'm business minded and I would love to get licensed and come do this, like Bree is doing, like Jules is doing, like Jerry's doing. Right now we've got 168 affiliates. Okay, we've got probably 10 to 15 licensed agents across the United States. We just launched in Canada. Okay, again, my chief of performance and delivery, Samantha Estaleo, she's Canadian. She's going through the licensing process right now. We're going to be launching a Canadian division. We just launched in Puerto Rico, right? So we want people that are expanding their phenomenal tax benefits if you want to move to Puerto Rico and start this. But there's tons of opportunities. So that's part of my purpose in going over that as well. So guys, again, if you have questions, I want to see those dropped in the chat. I'm going to answer some of those live real quick. Let's see here. And if you got a message from Brianna or Jules today, check your chat, right? Don't be that weirdo that got Bree's message and pretends like you didn't see it. That's called socially awkward. So just acknowledge her and say, hey, thanks, Bree. If you want to set an appointment, go for it. She's going to want to help and jump on a call with you. Lots of congratulations for Bree and for Jules. Maya says she has a question. So Maya, if you want to drop your question in the chat, I can go ahead and either answer it here or I can go live with you and we can answer your question live. Let's see here. Yeah, bank-owned life insurance. That's what you want to Google. That's the life insurance the banks are actually using. All right, I don't see any questions yet. Maya says, I feel my question might be long. Yeah, so Maya, go ahead and send it to me in the chat. And then I can read through it and answer it or go live with you either way. And then while Maya's doing that, so I want to just give you guys a sketched out example of how insurance agents, life insurance agents get paid. Okay, so we're going to do this without too much nerd speak on insurance because I don't want to lose you guys. Okay, so you have a life insurance policy. And just like with any insurance, you pay what's called a premium, right? That premium is going to have a portion that purchases death benefit. Okay, that's the money that pays out when you die. And then there's a portion that goes into cash savings, right? And so the death benefit, when you structure a policy correctly, when you own death benefit, you actually own a fractional share of ownership in the insurance company. Okay, so a death benefit equals equity ownership. You actually become an owner in the insurance company. That's great. Like I own Guardian. I'm an owner in Guardian, right? And this is awesome because it really aligns the interests like of the consumer and the company, right? The bank, the interests aren't aligned. The bank's going to pay me as little as possible and then try and loan my money out for as much as possible. And so with the insurance company, because I'm a partner, they're not going to do anything to me that they're not willing to experience themselves. We're partners. You see what I mean? Like if I'm dealing with this great giant organization that could squash me with one step, the way that I protect myself is I am on their team. If they squash me, they hurt themselves, right? So the death benefit equals equity. The equity gives me what's called a dividend. Okay, a dividend equals profit share. When the company is profitable beyond their expectations, they pay that profit to me in the form of a dividend because I own equity in the company. Now the cash savings here, this is the other part. The cash savings give me what a guaranteed interest rate. So I have a guaranteed interest rate of growth, plus I have my dividends. right? So my dividend plus my growth guaranteed interest rate on my cash savings, that equals my rate of return on the policy. Okay, so a properly designed policy for a sacred account is we want to minimize the insurance costs without too greatly diminishing our equity. So we want to own some death benefit so that we do have equity and we do get dividends. And then I also want to maximize my cash savings because that's the money that I can pull out. So for example, if I'm going to use my life insurance policy to pay off debt, I want to put in 10 grand and be able to pull out $8,000 or $9,000 of that right away to use that to handle my debt. The 10 grand is still growing like it never left. I can utilize the 8,000 or 9,000 to pay off my debt, right? So when I sell a policy as an agent, I'm going to get paid mostly on the death benefit, right? Most agents, when they sell you a whole life policy, they sell it for a high death benefit because that's what generates the greatest commissions. So they're going to get anywhere from maybe 50 to 100% or more. Right, I say 100% or more, like the company will in some cases actually pay them more than was collected, right? It's called a lead loss. Like the company knows on the back end, they'll be so profitable, they're willing to lose money the first year. So the agent selling a policy, they're gonna collect 50 to 100% commission on the premium going towards this death benefit. So let's say I have $1,000 a month going into my policy. If I'm an agent and I want to sell this to make as much money as possible, let's say I'm making 100% contract on my base premium, I would in that event try and convince you, hey, Bree, let's put 100% of it to the death benefit, right? And you're not used to anything different. You're used to that. You're like, oh yeah, with my car insurance, it all goes to the premiums anyways. With my health insurance, it all goes to the premium anyways. Like those ones don't have a savings account. So this is new for you. And I'm telling you, you pay into it. Don't worry, over time, the savings is going to grow. Well, in this scenario, $1,000 a month going towards the death benefit base premium, 100% commission. This agent just made $12,000 on a policy. Okay, that's a lot. Like even for me, $12,000 on one single policy, that's a lot. And so the agency and the industry, they sell most of their policies this way. Why? Because it makes the most money for the company, it makes the most money for the agent, and it makes the most money for the agency that the agent works for. Okay, so they're going to get 50 to 100% of the premiums going to the death benefit. The cash savings, they're going to get 2 to 3%. Right? So they could make 100% on the money that you're putting into it, or they could make 2 to 3% of the money that you're putting into the cash savings. Now, here's the problem is if I load this up with a high death benefit to maximize my commission and I lower your cash savings, you don't have reserves. You can't use that money, right? It's locked up. It went towards premium costs and it went towards commissions, to be quite honest. And so you're not able to be your own bank. It's like you're putting money in, not any different than the regular bank. You put money in, you can't pull it back out now. The bank run happens, right? You put money into the policy, it all went to commissions and fees the first year, there's nothing there. So if you're doing, a whole life policy or a universal life policy or any sort of cash value based policy, and in the first year, you're not seeing 70 to 90% of what you put in there is available day one, then your agent designed that policy to have a high death benefit and a low cash savings so that they could make a maximum commission. That's the cut and dry of it, right? Now, I could do the opposite. If I know what I'm doing, I'm going to allocate maybe 10 to 30% of what you're putting in this towards the death benefit. Why? Because I do want to own shares, I do want dividends, and I do want profit. But I want to optimize it so I still can pull money out and I still have my cash value. That means that I'm going to put 70 to 90% of it in my cash value. Right? Like think about this. I could make, 12K just to sell it straight, all the death benefit. You're not going to have any cash. You can't bank with it. You can't use it, but I made a big commission and that's good. Right? Or I design it so it's optimal and it's the same way the banks do it. Okay. To do that, I'm going to make substantially less money. Right? Just to give you an example of what I might get paid on this. If I was doing $1,000 a month, let's just look at the math on this. $1,000 a month times 12 months. It's the wrong button. I might make 2 grand on this if I design it correctly. right? The company might make $2,000 to design that policy, $1,000 a month going into it, designed the right way. Okay, you've got 70 to 90% of your cash value available. You own enough dividend producing death benefit that between the dividend and the guaranteed rate, you're making about a 3 to 5% annual return long-term, tax-free, and you're able to use that for banking. And I get paid $2,000 to set that up as an agent, right? Or less, like $2,000 is on the high side, right? Or less. And that's going to be me also then servicing you and teaching you, like, here's how you use it. Here's how you take your loans. Here's how you pay yourself back. You're ready to buy a car. Let me help you with that, right? And so that really is like the difference on how agents get paid. And it's important to know this as a consumer. As a consumer, if you're looking at a life insurance illustration that has very low cash savings, okay, that means most of the money is going to the death benefit, and the agent is making a lot of money in commission to design your policy in a way that's not probably in your best interest. Between the two, okay, not everyone is going to do it this way. It's not a blanket statement, but between the two, you probably want the one where you've got more cash available, an optimized rate of return, and you can be your own bank. Not the one where you've got no cash value, very low rate of return, and you can't be your own bank. Okay, the agent has to make the decision between, do I make 12K or do I make 2K? Right? Which one is it going to be? And this comes down to, does that agent know how to design it the right way, right? Management doesn't have incentive to teach them this, by the way. Why would a manager teach their people to sell something that's 6 times less profitable? So the chance that you're going to go to Joe Schmo who sells life insurance and get this plan, very slim. Okay, I literally have a client that he needs to go back through his sacred account course. He got a little confused on his policy, went to another agent, and the agent was like, I don't understand why it's set up this way. This is wrong. We had another client in Utah where she was looking around and the agent looked at the policy. He's been in the business 30 years, couldn't make sense of it. He could not make heads or tails of how we designed it the way we designed it. He's like, this has to be wrong. There's something, no, it's not wrong. That's how you should design a life insurance policy. That's called designing it in the best interest of the client. Okay, so if you're a client, like that's one of the things I want to show you, right? The death benefit, you want that, but you want to have high cash savings. And if you don't, you're seeing that the agent made more commission. Doesn't mean they had bad intention, but it doesn't mean that they're out to gyp you and steal your money. It probably means that they never got taught the right way because their management's not going to teach them to sell something that makes 6 times less money for the company. Right? So that's going to be the difference. Now, if they know and they're still doing it, then yeah, they've got bad intentions. They could be selling it correctly and they're choosing not to. Okay. Now, the other thing I want to point out on this is compared to the bank, right? The bank is making more than this on your money and paying you nothing and providing no service. Who's had this experience recently where you had to go to the bank or call the bank and it was just a terrible experience? Customer service was a long time. They weren't helpful. They were on hold. There was long lines. They're not really providing any value. Okay. Versus I set up a life insurance policy. Yeah, the agent might make 2K in fees and all of that, but he's actually providing value. Right? He's helping me. In our case, we're educating you. We're giving you courses. We're giving you training. We're giving you support on the back end. We have an entire staff called a mapping team that when you set a policy up with us, you have them for life on demand to help put together strategies, statements, how if I'm going to take a loan out to do real estate, what are the numbers going to look like? They'll actually build that for you free of charge. Like we just include that, right? Because we want to teach people the banking concept. We want people to become financially independent. A greater degree of financial freedom in life means I don't use their bank, I use mine. That's increasing my financial freedom. Okay. The second aspect of that is 2K yet less than 12? Yeah, but is that something to snuff your nose up at? No. So if you spend, let's say you're like Bree, okay, and you spend 6 hours calling a client, educating them, following up with them, helping them get started, servicing them throughout, and they do a policy and the commission pays out and you make a couple $100, or let's say that she makes $600, right? She doesn't even make the 2K. Let's say that she makes $600 to do this. And she spent 6 hours with a client. Is $100 an hour currently competitive with what you make today? Right? Like you can, like, this is not bad money to, like, you're helping people. It's a great purpose and it's a great income. So for those of you that are watching and you're like, hey, I want to help. I love Wealth Dynamics. I love the Sacred Account. I'm a fan of it. I'm winning with it. I'm looking to expand right now in the United States, Canada, and Puerto Rico. Okay, we'll take it further than that as we go, but there's a lot of territory to cover just right there. So if you're watching and you're an active and winning client and you'd like to become an endorsed wealth mentor or an ambassador with us, I want to help you do that, right? I've got right now a track to help you get there as fast as possible. I want to train you myself, get you up and running myself, and teach you to help people get out of the position they're in with their finances and improve and become educated and become solvent and achieve greater financial freedom. I can't do this just by myself. Okay, it's going to take an army. Okay, so if you're interested in this, like the reason I show you this is to show you that you can make money doing something really good for people. Like your job is helping people become their own bank. Imagine that. Helping them get out of financial slavery, helping them get out of debt, helping them become solvent, helping them achieve passive income. That could be your full-time job. Right? With an organization that's expanding, we want to teach you, we want to educate you, we want to invest in you, right? Like the reason I had to go work for myself, and I'll wrap up with some questions on this note, right? The reason that I had to go work for myself at the age of 18, I decided I'm going to be an entrepreneur, is I never had an employer that was willing to invest in me the way I could invest in myself. Okay, they just wanted me to show up and punch the clock and get the job done. There was no pursuit of excellence. Okay, I call it being in the arena. Like in the arena comes from a speech Teddy Roosevelt did in Paris, France, right? And he talks about being in the arena, like showing up every day, putting the work in, risking yourself, possibly failing, getting, scuffed up, having the blood, sweat, and tears, knowing that if you win, you achieve your goal. And if you lose, you become stronger and have an adventure as a result. And I wanted to be in the arena. I wanted to really be doing something in my life. I didn't want to be a pizza guy, right? Even as a personal trainer, I could be like, okay, cool. There was purpose behind that, but I got bored of it. I couldn't spend the rest of my life telling people exercise and eat less. Just move your body and consume less food, right? After a while, you get kind of like, I'm kind of tired of beating the same drum on that. It's a basic function, right? Like that's something that I want to make sure that people do for sure, but it's not my life's passion. I didn't want to be an accountant and just stare at numbers all day. I certainly didn't want to be a pizza guy for the rest of my life. Right? So if you're watching this, whether you're an entrepreneur, a business owner, an employee, you're doing something right now. I'm not interested in people that have nothing going on, by the way. If you're currently unemployed and you're like, yeah, I hate my job, I've got nothing better going, that's usually not who I want to work with. I want people that are like, they're winning, but they want to do better. Right? They're busy with a career field and they're like, this is good, but there's got to be more out there. That's the person I want to work with. Right? That's the person I want on my team. Okay, so if you're interested in becoming an endorsed wealth mentor or an ambassador, I want you to reach out to me directly. You can email me, jerry@wealthdynamics.com, right? jerry@wealthdynamics.com. And then I'm going to answer if we have any questions. And then guys, just one more check-in again on the book and also setting up an appointment with Bree or with Jules, right? So if you've not done this yet, we covered a fraction of things today, right? But if you go to jerryfetta.com/B2F promo, okay, you can go get a free copy of my book. You cover the shipping, we'll send the book out to you. And this is what everything is based on, right? Like if you start with us, we're going to get you set up probably with your sacred account or some education or something that's beginner. Then we're going to say, cool, we're going to now do the blueprint with you. That's the service we deliver. So this is going to give you a lot of education on what we do, why we do it, how it all works. And that's going to be, something that we're going to actually walk you through as a client, right? So if you've not gotten a copy of this or read this book yet, it will change your life financially. Like I spent, 10 plus years researching and applying this myself. So go to jerryfetta.com/B2F promo. And then secondarily, if you've not set up a consultation with Brianna, okay, or with Jules, I want you to send them a chat right now in the DM, say, hey, I want to set up a consultation. If you're clients, I'm talking to you guys first. Okay, if you're a client, I want you working with an endorsed wealth mentor. Okay, do not go about this alone. Don't wait to receive help. Let us know, like, hey, I want one-on-ones. I want to meet with Bree. I want to meet with Jules. I want to get my blueprint progress speeding up, right? So let me jump into some questions here. All right. Okay, Maya has a question. So this is a bit longer. So I'm gonna just read through it really quick, rather than going live here, just for the sake of time. My parents don't have any type of life insurance. I've talked with my father about this. He says he's got none. He's 72. My mother is 52. My mother has always been a silversmith and makes less than 500 a month. House is given to her from her mother when she passed. My question is, I know they have no money for long-term care. I've just passed the part on the blueprint book. Is there a way I can finance them to receive long-term care, or would they have to have their own life insurance? I know my father is no longer within the age range to apply. What would be the best solution there? Okay, good question. So long-term care insurance, this is when somebody is older typically, and they end up, needing, either in-home care, someone to help, with getting dressed or eating or getting to the bathroom or cleaning or whatever it would be, bathing. Like it gets to the point where an older person isn't going to be able to take care of themselves, right? The reality is for someone that's younger, and they're the kid in the equation, the adult kid, most of us are going to be left holding the bag with our parents. Okay, that's just something we have to accept. Like that's part of the game, is that your parents probably didn't plan ahead, right? Unless they did, but if they didn't, and they're like my parents, they didn't. And that means when they're in that condition, either we're going to have to take care of them or the government's going to have to. Those are the two options there, right? So if we're going to take care of them, what does that look like? Okay, so if they're older, you cannot generally put a life insurance policy in place for them that's going to have the long-term care rider. Like they have to be the insured. So if they're not going to get approved for life insurance, they're definitely not going to get approved for the long-term care, right? Doesn't mean it's a no-go. We could check it out. Like age is not strictly a disqualifier. So if they're older and still healthy, it still might be possible to some degree, Maya. So check with Brianna and just work with us on, okay, let's take a look and see if it can happen. Okay, so that's the first thing. The second thing is if they can't for some reason, then it's either you need to increase your income and your savings and your reserves, not only to cover yourself, but to cover them too. Okay, and I know for some people that sounds uncomfortable. It's like, that's a lot of money. Long-term care costs could be $5,000-$10,000 a month for a period of 2 or 3 years on average. Right? Like that's the worst case scenario. So I need to produce more income and save and invest to build up for that, not just to be financially independent, but to also then take care of my loved ones. Okay. Or I need to have the government helping them. Now, the government's not going to help them if they have assets, right? And so this is where either, the government, if they're going to have like a Medicaid situation coming in, they're going to seize the assets of the parents. You have to prove you're basically in poverty, right? And then you can go into a Medicaid facility. Or you need to set up a long-term care asset protection trust for them now, well ahead of time, so that on paper, your parents don't own anything. It's all owned by the family trust. Right now, you can't do this like right before, like if you already know they're going downhill, you don't want to do this now because it's going to look like you're baiting the system, right? But if you know, okay, things are fine now, this is just precautionary, I just want to set this up in advance so that if something happens, I'm covered, right? It's all about intent. So if I'm doing it that way, I could set up a trust, I could start working on that now. And that's something we can help with. We have a legal team that specializes in this exact thing, Maya. So that's definitely something to check out. It still probably will require some planning and some investment of time and money and education, right, to get all that going. But it's either going to be we can do a policy for them even though they're older, or we do the Medicaid trust, and that's something that we can set up with them. Or you say, hey, I'm gonna just step up the income a lot, and I'm gonna self-finance this thing, right? So either way, the answer is get on a call with Brianna and schedule that out. We can get help with that for you for sure. Good. Let me see if there's any other questions before we wrap up today. Let me just check Facebook really quick. Caleb says, working on funding my Sacred account, almost ready to borrow to pay off my wife's car. Thanks to Jerry. Never felt more comfortable with where I keep my wealth after this banking fiasco. That's awesome, Caleb. Thank you so much for that success story. Guys, really, like we're going through a phase right now, like SVB just went down. They're the first of many. If you remember 2008, one bank did it first, then everyone else followed. It's probably going to be similar this time with the bank runs that are happening. If you're uncertain about putting your money in a bank, I talked to a client yesterday. They're like, hey, I've got 150 grand with Wells Fargo. I don't trust them. Should I move over to Bank of America? And I'm like, no. Like you're going from one bad idea to the same bad idea with a different brand on the sign. Like it's the same exact system. Right? Put it in real assets, put it in a Sacred account, put it in real estate, put it in gold and silver, put it in something you can own, control, understand, you like it, it's yours, right? So if you're wanting to get out of the banking system now, probably is a good time to get out of the pool. You don't want to be the last one in there, right? So reach out to us. A couple of quick announcements. So Monday afternoon, we are dropping our latest edition of Mini Mogul Monday. That's me with my godson, Sammy Larone. It's finances taught for kids by a kid. So you can watch that. That's going to be on our YouTube channel Monday at 4 p.m. We did just do an entire reorganization on YouTube, which is full of great playlists. Every day we're covering a different topic. The second thing is we are releasing our client handbook. Okay, if you're a client, I want you to reach out to my team and let them know, hey, I'd like the handbook. We'll send you an e-copy of it for free. This gives you heading on how to be successful as a client with Wealth Dynamics. It's like an owner's manual for being a client here. Everything is in there. I spent 6 hours on Monday writing it. And so that's going to be just a very big piece of stability and clarity. So that's a major announcement, is reach out and get that. Any service you purchase with us, that's now going to come with it. And you can even order a physical copy for like $10. Like if you really want to have a copy in hand, if you're really that serious, you can go to store.jerryfetta.com and order a physical copy. Otherwise, guys, have a great weekend. Thank you for tuning in. Make sure that you like, share, subscribe, get some rest. I can't wait to see you guys in the arena this week on Monday, pushing, working on your goals, working on your blueprints. I think I see one more question or comment. Let me just check this really quick. Lauren says, thank you for an informative session. Awesome. Thank you very much, Lawrence. Guys, I'm going to tune out. I'll see you next time.